First Republic bank crash. Another bank is on the verge of collapsing, and we're not talking about the piggy bank on your nightstand. It's been just a little over a month since two other large regional banks were taken over by the Federal Deposit Insurance Corporation, FDIC, and now it seems like another one is biting the dust. But don't worry, the Wall Street Journal reports that U.S. banking regulators are in negotiations with a short list of two large banks, JP Morgan Chase and PNC, to acquire First Republic Bank before the weekend is over. I mean, if there's anything that can be done before the weekend is over, it's gotta be important, right? Should no suitor be chosen, the FDIC will take the bank into receivership and begin unwinding its assets. So basically, it's like your parents taking away your allowance, but on a much larger scale. Now, the latest troubled regional bank that focuses on high net worth clients and their businesses has been struggling for several weeks. I mean, if high net worth clients are feeling the pinch, imagine what the rest of us are going through. Like other smaller banks, First Republic saw depositors withdraw vast sums of money from the institution as concerns grew over its financial stability. I mean, it's like a game of musical chairs, but with money. So what does this mean for the banking industry, and how will it affect consumers and businesses? Stay tuned as we try to make sense of it all and hopefully make you laugh a little along the way. In this channel, we do tons of research about the stock market, and our goal is to help you on your journey to financial freedom so you can live life on your own terms. If you like this video, make sure to destroy the like and subscribe buttons so that you won't miss any of our future content. First things first, First Republic Bank was founded in 1985, so it's a relatively new bank compared to some others. It started out in San Francisco, California, and expanded over time to other states, including Florida, Massachusetts, and New York. At first, the bank focused on serving wealthy individuals and their businesses. They offered services like banking, loans for buying property, and managing money. In 2007, a larger bank called Merrill Lynch bought First Republic for a lot of money, $1.8 billion. But in 2010, Merrill Lynch's parent company, Bank of America, decided to sell First Republic to some private investors. After the sale, First Republic became a public company again, which means that anyone can buy shares and own a part of the company. Right before the collapse, First Republic Bank was known for serving wealthy clients, but they also offered services to other individuals and businesses. They have branches in several states and are known for their personalized approach to banking. So what's the narrative here? It seems like the banks are playing a game of dominoes and the investors and depositors are getting worried. Silicon Valley Bank, SVB, and Signature Bank have already fallen, and now people are afraid that First Republic Bank could be next. But wait, it gets even better. Even if someone wants to buy out First Republic, there are regulations and rules that could stop them. JP Morgan, one of the big dogs in the banking world, has already reached its limits for acquiring nationwide deposits. It's like the banking version of, sorry, you've reached your maximum number of items for this purchase. First Republic Bank's wealthy depositors are feeling like they're in the middle of a playground brawl and are moving their money to the big boys who they think are less likely to get beaten up. Apparently, the bank has lost roughly $70 billion since the collapse of SVB. That's a lot of money. I hope they didn't lose it under the couch cushions or something. It turns out that First Republic Bank has been making some risky bets, kind of like going all in a game of poker, but without the cool sunglasses. And as we all know, sometimes you lose big time just like they did. They invested in some long-term treasury bonds and other things that took a dive after the Federal Reserve decided to raise interest rates. It's like they backed the wrong horse at the racetrack, and now they're stuck with a horse that can't run. And to make matters worse, a lot of deposits at the bank were uninsured, which means that if the bank goes under, depositors could lose their money above the FDIC limit of $250,000. So it's no surprise that the bank's wealthy customers have been withdrawing their funds faster than a magician pulling a rabbit out of a hat. So, you know how in the movies when someone falls, they usually take a bunch of other people down with them? Well, that's what everyone is afraid is happening with First Republic Bank. The collapse of Silicon Valley Bank and Signature Bank caused a stir, and now investors and depositors are worried that First Republic might be the next bank to bite the dust. But wait, there's more. Even if someone wanted to buy out First Republic, they might not be able to because of peaky regulations and the unfair advantage that bigger banks already have. JP Morgan, one of the country's largest banks, can't even buy any more deposit-taking institutions because they already have too many. So much for being a monopoly, huh? Speaking of deposits, First Republic's wealthy depositors have been moving their money to bigger banks that seem more stable. Can you blame them? After all, 68% of First Republic's deposits were uninsured, meaning they were above the FDIC limit of $250,000. That's like walking around with a wad of cash in your pocket. Not very safe. And just when you thought things couldn't get worse, First Republic is also facing unrealized losses on their long-term treasury bonds and other investments. It's like investing in a hot stock and then watching it crash and burn. Oops. Luckily, regulators stepped in to protect the uninsured deposits at Silicon Valley Bank, but First Republic's depositors weren't taking any chances. They withdrew a whopping $70 billion from the bank, causing a panic. But don't worry, Treasury Secretary Janet Yellen came to the rescue and promised that the government would protect depositors in struggling banks like First Republic. The stock rebounded and everything is stabilized. Crisis averted. First Republic Bank was in hot water and everyone was freaking out, even the bigwigs at Bank of America, Citigroup, JP Morgan Chase, and Wells Fargo. They decided to throw First Republic a lifeline and deposited $30 billion to keep the bank afloat. It's like a big game of financial hot potato. Nobody wants to be left holding the bag if First Republic goes belly up. But hey, at least they're all in it together. It's like a group project in school where everyone has to do their part to make sure nobody fails. According to Reuters, the $30 billion in deposits that First Republic received from 11 large banks might not be enough to solve the bank's problems. First Republic is considering downsizing or selling parts of its business if it can't raise more funds. This means that the bank might have to let go of some employees or sell off some of its assets in order to stay afloat. JP Morgan Chase CEO Jamie Dimon and other top bank executives met on Tuesday to discuss additional options to help First Republic. The Financial Times reported that one possible plan being discussed is to convert some of the $30 billion in deposits into a capital infusion. This would give First Republic more flexibility to spend the money, which could help the bank address its financial problems. Despite the announcement of the $30 billion deposit by the big banks, multiple rating agencies have downgraded First Republic's credit rating to junk status. S&P Global analysts have said that the deposits might not be enough to solve the bank's problems, and that First Republic is likely facing substantial challenges related to its business operations, liquidity, funding, and profitability. In simpler terms, First Republic Bank is having financial difficulties, and the $30 billion deposit it received from other big banks might not be enough to solve its problems. The bank may have to sell parts of its business or downsize to stay afloat. Other banks are trying to find ways to help First Republic, but rating agencies have downgraded the bank's credit rating to junk status because they think the bank is facing serious financial challenges. Well, it seems like First Republic is trying to avoid getting caught in a Twitter frenzy like SVB did. They've been telling their investors that they're not as risky as some other banks, especially SVB, which suffered from a social media-induced bank run. First Republic says that no one business sector represents more than 9% of their deposits, with the largest being diversified real estate. And hey, only 4% of their total deposits come from tech-related businesses, so they're not putting all their eggs in one basket. Sure, 68% of their deposits are uninsured, which is higher than most of their competitors, but it's still way lower than SVB's crazy 94% uninsured deposits and Signature Bank's 90%. So they might be a bit problematic, but at least they're not as fragile as some others. That's what Karen Shaw Petrow, managing partner of Federal Financial Analytics, thinks anyway. Well, folks, it looks like the party's over for First Republic stock. This week's 75% drop has investors feeling like they went to bed with a few shares and woke up with a pile of worthless paper. But don't worry, it happens to the best of us. Investing in financial stocks can be like riding a unicycle on a tightrope over a pit of alligators. One minute you're cruising along, and the next you're being devoured by the jaws of financial ruin. So what can we learn from this? It's important to remember that even the best-looking banks can go belly up faster than you can say FDIC. If you're going to invest in financial stocks, you need to be prepared for the ups and downs that come with the territory. But hey, let's not end on a down note. There are plenty of other stocks in the sea, and with a little bit of research and a lot of luck, we can find the next big thing. So keep your chin up, stay diversified, and remember, there's always money in the banana stand. Thanks for tuning in, and don't forget to like, comment, and subscribe for more insights on the world of business and finance.